Welcome back, my friends. As you may have noticed, speculative investments are having a disastrous year. The Nasdaq Composite has fallen sharply from its all-time high a year ago. For those of you not already familiar, the Nasdaq Composite is one of the most widely followed stock indexes in the US. It is usually one of the three headline indexes that stock market commentators typically cite. The other two are the Dow Jones Industrial Average and the S&P 500. The Nasdaq has a high concentration of companies in the technology sector. And it includes many of the younger, fast-growing tech companies. More importantly, it includes many tech companies that have never been profitable. So, the Nasdaq Composite Index is often viewed as a barometer of how well tech companies are doing in general. If you follow this channel, you already know that layoffs, inflation and rising interest rates are roiling the tech industry. The stock prices of many big tech companies have cratered over the past year, and since January in particular. Tech companies are slowing spending and responding to weakening macroeconomic conditions. Up until the end of last year, Wall Street analysts valued high growth at the expense of profitability. So, lack of profits in tech companies was not seen as problematic. But what a difference a year makes. Investor sentiment on Wall Street has shifted dramatically. Now, Wall Street analysts are demanding growth of profits. And that is some kind of doomsday for the many tech unicorns that went public but were never profitable. They are now faced with three tough choices. 1. Become profitable in a hurry, or 2. Raise more venture capital on decidedly unfavorable terms, or 3. Merge with another company. And, if you follow this channel, you already know that I have been predicting a wave of consolidations. Especially in the tech sector. And, especially among the unprofitable tech unicorns. These companies were always skating on thin ice, in my humble opinion. Now, the inevitable day of reckoning has come. And, I think that now, we are seeing the first of the merger deals that are the proverbial pebbles that are starting the avalanche. You may not have noticed the announcement, but grocery delivery startup Getir is now acquiring its rival Gorillas. Getir did not disclose financial details for the deal. But, they said in a statement that it underscores consolidation in the sector. The takeover has been in the rumor mill for a while now. The deal values Gorillas at $1.2 billion, down 15% from its last valuation. So, what does this mean for tech companies? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Turkish grocery delivery firm Getir acquired its German rival Gorillas. For an undisclosed amount, the company said Friday. Markets go up and down, but consumers love our service and convenience is here to stay, said Getir founder Nazim Salur. The super-fast grocery delivery industry will steadily grow for many years to come, Salur continued. And Getir will lead this category it created 7 years ago, Salur also said. Loss-making grocery delivery services are enduring a tough market environment, said one Wall Street analyst. Investors are re-evaluating positions in unprofitable tech unicorn companies. These companies are the most exposed to the worst problems in the economy. The effects of tighter monetary policy, fears of an upcoming recession, and a rising cost of living. The acquisition deal values Gorillas at $1.2 billion. And it values Getir at $10 billion. Those numbers represent a 61% discount on the valuation of Gorillas since its last valuation. And a 15% discount on the valuation of Getir from its last valuation. Unconfirmed reports claimed that the acquisition would be paid for with Getir equity and cash. Official terms of the deal were not disclosed at the time of the announcement. Getir is based in Istanbul. This deal underscores how Getir leads consolidation in this sector, said Getir in a statement. Gorillas was probably the most hyped tech unicorn in the rapid delivery sector. It promised its customers delivery times as low as 10 minutes. And, as you probably have guessed, Gorillas has never been profitable. So, the heavy discounts were basically subsidized by venture capital. Gorillas was founded in May 2020. Like a lot of other tech companies, Gorillas aggressively during the coronavirus lockdowns. Gorillas was most recently valued at $3.1 billion in 2021. German food delivery company Delivery Hero led the round of private financing at that time. Things have not gone well for Gorillas in 2022. The company cut hundreds of its employees earlier this year. It was also forced to cut service to markets generating less revenue: Italy and Belgium. Gorillas had only two choices: sell or go out of business, said independent retail consultant Britton Ladd. Getir is acquiring Gorillas because it is getting its dark stores. Dark stores are small facilities that basically serve as tiny warehouses. Dark stores are designed for online delivery rather than in-store shopping, said Ladd. The deal makes sense for Getir, but it's a short-term solution. Many countries have enacted laws or are enacting laws to shut down dark stores, Ladd said. Getir, which was last valued at $11.8 billion and has operations in 9 countries: Turkey, the US, UK, Germany, France, and others. Like many tech unicorns, Getir also cut hundreds of positions earlier in 2022. The rapid delivery industry starting what I think will be a great wave of consolidation. Getir also purchased grocery delivery startup Weezy earlier this year. German firm Flink's Austrian subsidiary shut down earlier in 2022. Yes, my friends, the frothy days of sky-high valuations for tech unicorns are over. The great economic soufflé is collapsing in spectacular fashion. The tech-heavy Nasdaq Composite had just peaked in value almost exactly 1 year ago. That all-time high was double its value since the early days of the pandemic. 2021 was a big year for initial public offerings IPO when tech companies' shares were publicly traded for the first time. Electric pickup maker Rivian had a blockbuster IPO. That was just the latest in a record year for new issues. Hiring was booming. Employees of big tech companies were frolicking in the astronomical value of their stock options. What a difference a year makes. Shares of Meta have famously fallen by over 70% from their highs. That fall has wiped out over $600 billion in value this year alone. Investors in big tech companies have lost about $7.4 trillion in the last 1 year ago. Aggressive interest rate increases have closed off access to easy capital. Raging inflation has made any company that is merely promising a future profit a lot less valuable today. Shares in cloud companies have plunged. Not to mention any company having to do with cryptocurrency. Tech companies across the industry are cutting costs and laying off employees. Employees joined those hyped pre-IPO companies in droves. New employees took much of their compensation in the form of stock options. That has backfired and they are now deep underwater. IPOs this year slowed to a trickle after having huge years in 2020 and 2021. Tech companies thrived during the pandemic. It was a distorted glimpse of an emerging world of work and play from home. And the federal government fanned the flames with government-backed funds. Many unprofitable tech darlings raised billions in initial public offerings. This flooded the coffers of investment banks and venture capital companies. But these unprofitable public companies have all now basically crashed. Some may not even survive. Shares of Rivian have fallen more than 80% from their peak. Software engineers had gotten used to outsized compensation packages. Especially from Meta and Google. Companies offered more than $700,000 for a qualified engineer or project manager. Some top-level engineers could make $1.2 million a year. But those days might be over. Productivity software firm Asana, just as one example, has never been profitable. Yet it was able to go public in 2020. And it offered engineers starting salaries of up to $198,000. Today, those days seem like a distant memory. Cisco cut 5,000 employees. Meta laid off 11,000. Amazon cut 10,000 jobs. And Twitter famously fired 3,700 people. So far in 2022, job cuts at tech companies are over 130,000 workers. HP announced the elimination of 6,000 jobs over the next 3 years. Naturally, Google employees are worried that layoffs are imminent. Remember SPACs, the special purpose acquisition companies? If you follow this channel, you already know that SPACs enable companies to go public quickly, bypassing the typical process. They were quite a phenomenon in 2020 and 2021. Investment banks were clamoring to underwrite them. Private investors rushing in with new pools of capital. SPACs enabled companies that did not fit the traditional IPO profile to backdoor their way onto the public market. An unbelievable 619 SPACs went public in 2021 alone. There were only 496 traditional initial public offerings. This year has basically been a disaster for both SPACs and traditional IPOs. Venture capitalists spent the past decade minting tech unicorns. Last year, venture capitalists invested $325 billion into venture-backed companies. Needless to say, those days are over. Now venture capital comes on unfavorable terms. You just don't know what it's going to be like going forward, said venture capital leader Jeff Grabo. VCs are rationalizing their portfolio and supporting those that still clear the hurdle, Grabo continued. Wall Street analysts are now focused on growth of profits and not just revenue. Tech unicorns can no longer count on venture investors to subsidize their growth. And Wall Street analysts no longer value high-growth, high-burn companies. Now it's impossible for many companies to go public without huge haircut to their private valuation. A slowing IPO market informs how earlier stage investors behave, said David Golden, managing partner at Revolution Ventures in San Francisco. When the IPO market becomes more constricted, that circumscribes one's ability to find liquidity through the public market, said Golden. Most early-stage investors aren't counting on an IPO exit, Golden continued. The odds against it are so high, particularly compared against an M&A exit, Golden added. We're reverting to the mean, Golden said. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.